Blackboard course, so I can just put the exams right in Blackboard. But I'll also send them to you guys just to, so that everyone gets one. But the chapter 4 and 5 exam, it'll be listed in Blackboard. It'll also be available in Blackboard. You guys all have your own Blackboard show. So anyway, today we're just going to do foreign currencies. This shouldn't take too long, I don't think. The wrong thing. Hold on. I'm sorry. Let me clean this up. Oh. I just got out of a meeting. All right. So now we're going to get into foreign currency transactions. So just to kind of put a context to this, so chapters 4 and 5. Oh, I want to talk about that in a second. Chapters 4 and 5. Oops. These are on accounting differences. And chapters 6 and 7 will be on foreign currency translation, transactions and translations. So this one is the accounting rules are different, and this one is that the money is different. So these are going to be the two. It's kind of so far this is going to be the difference between these two. So one has to do with the accounting rules, which are a little bit different, and we're also going to have the foreign currency. I know what I was going to mention. Instead of going over the multiple choice, we usually go over that in class, but it's not, with only 3 people total taking this as a CBA. I think I'm just going to, I'll leave the multiple choice on there as extra credit. So there's 5 of them, so you have to up to 5 extra credit points. But the problems will be similar to what we did in the handouts. And then the 5 extra credit points will be for the multiple choice. Yeah, I think this is a time saving thing. And even if you get them all wrong, you can still get 100% on the test. Okay. So, foreign currency transactions, and basically we have direct quotes, and the direct quotes are for $1 US, and the indirect quotes are just the opposite. It's for one foreign currency. What does that mean in US dollars? And actually, this indirect one is one we use more often because it's usually someone gives us a foreign currency, we have to translate that into US dollars. But one of the things that they sometimes will give you is that they'll give you one and not the other one. And so how do you how do you get from one to the other? And basically you just do the reciprocal of it. So 1 divided by it. So this will be 1 divided by, let's copy that, I suppose. Okay, so our British pound, $1 will get us 0.85 of a British pound. But if someone hands us a British pound, it's worth 174703. So we just take the inverse of it. So Canadian dollar, we would get $1.30-ish for it. Reciprocal of that. I don't know, 76, 77 cents, somewhere in there. And it works the same going the other direction. Swiss franc, this one's not going to be too much different, but Swiss franc is worth a little bit more than ours, so we gave them $1. How much will we get back? Oh, 96 cents. Oh, we got one more. So if we give it $1, we give us 6.85 yuan. Okay. So you just take the inverse of it. Get you there. There should be a. Hold on a second. That can't be right. What is that? 17? I gotta do that one again.
I think it's just like 0.174703.
Okay, all right. So that is okay. Yeah. Okay. So these are the exchange rates, and nowadays it's more computerized. Back in the day, you used to be able to do some. There used to be a big thing on trading, uh, because you could sometimes you could trade into foreign currencies, take those foreign currencies against each other, and then bring it back into U.S. dollars. And sometimes it would be because you know you can actually make money doing it. They usually have this would be like I say this is before computers basically were really heavily used, but they would have these traders would trade kind of in circles. They trade into Swiss francs, francs into German Deutschmark back into dollars, and by the time I got trade back into U.S. dollars, $100 became $100 and 52 cents or something. And if you did that with large dollar amounts, you could actually make some money. I remember there was a trader that he had a big account. He had a $700 million account, but he made $300 million for this one bank in 1 year just by doing that kind of stuff. I don't think there's that much inefficiency anymore in those markets, but back in the day. All right. Spot rates are today's rates. Forward rates are for purchasing and selling foreign currency sometimes in the future. So forward rate. We'll talk a little bit about this stuff. Differences in interest rates cause premium and discounts in forward rates. So premium foreign interest rates are lower than U.S. rates. Discount foreign interest rates are higher than U.S. interest rates. This kind of definition stuff. Transaction exposure to foreign risk. And so this is one of those things that, for at least the initial stuff we're going to go through, doesn't really matter too much, but later on we'll see that it can. Okay, export sales. Sale to be received in foreign currency. This isn't too bad. This stuff isn't bad. Okay. Problem 2. Do we have a problem 1? Oh, yeah, we did. Change one. Okay, so there's problem 1. So here's problem 2. So they made a sale to an Australian buyer for 10,000 Australian dollars. Okay, now here's the thing. Sometimes foreign transactions are done in US dollars and sometimes they're done in the foreign currency. If they're done in US dollars, there's no problem. There's no risk. If they're just going to buy these in US dollars, it wouldn't matter what the translation rate is. But because this is in Australian dollars, now we have to convert it. Okay, so what was the value of the sale at the time of the exchange? It would just be 10,000 times 0.7. Was that 7,000? I think 7,000.
Yep.
So 10,000. I'll say I'll put an AU in front of this. That's Australian. So $7,000 will be our. Ooh. Okay, it doesn't say these were made on account, but I guess they were. I should have put that in there. Assume these are made on account, so it would look like this: accounts receivable. Asset going up for 7,000. And sales also going up by 7,000. Okay, So it's like April 1st. They sent us the 10,000 Australian dollars. And at that point in time, the exchange rate was 67 cents. Okay, so what was the value of it? $10,000 times 0.67. Okay, so that's worth 6,700. Okay, so that is going to be our cash. That's not how you spell cash. It's an asset going up. Okay, now we got to take this accounts receivable off the books. Because they no longer owe us, they just paid us. Oops. So there's an asset going down, they don't want to, so we're giving up that asset. Uh-oh. They don't balance. What do we probably need to do?
Add like a second adjustment or something, right? Under the
Yeah, now we recorded this at $7,000 US dollars. We got back 67. Is this going to be a gain or a loss?
plus, right? Because it's you got paid less.
Yep. So this will be a translation loss of $300. And that would go on the income statement. Okay. Same thing. Okay, so 50,000. And the exchange rate was 15. 7,500, I think. Yeah, I checked that. Oops. Okay, let's see, this would be, oh, wait a minute, copy that, copy this. So when we actually got this, it was 18. It's 9,000. Okay, so this would be cash. Oops. We have to take the accounts receivable off our books at the, we put it on at. So we take off 7,500. Okay, and will this be a gain or loss?
Gain.
Gain. Yep. Translation gain of 1,500. And by the way, you might say, well, why don't we put that right into sales? Well, you don't put that into sales because it's actually not due to sales. It's due to the change in the currency. So you'll split it out separately from sales. It's the same thing. Oh, that's a little bit of a twist on this one. Okay, it starts out exactly the same. Okay, so 20,000. 75. Yeah, I think that's it. Okay, so this one we'd have our accounts receivable. Okay, now year end. The Australian dollar had an exchange rate of 77 cents per Australian dollar. Make the year end. Okay, so yeah. So this is the value of it at year end. whatever that is.
15,400.
5,400. Okay, so what are we gonna do with that?
If it's not received, is it like post dated? Or does it just stay pending? It's not like you didn't get the cash yet.
Right, we haven't gotten they haven't got the cash yet, but we need to record this on the books. Are we gonna have a gain or loss?
Gain.
Gain. And right now the gain is what, 400?
Yeah.
So translation gain will be 400. We'll put that on the books. And we need to put it on the other side here. So what we're going to do is put it right into the accounts receivable. The accounts receivable just went up by $400. We're going to recognize that 400 at year end. And put it right into the accounts receivable. Okay, excuse me, coming down here. At year end, or not year end, at the time they received it on the 15th, 80 cents. 16,000. Okay, so I'll do the easy part. How much do we need to take off for the accounts receivable?
$1,000.
We're going to take off the
Oh, yeah, the 15,000.
so 15,000 and 400 is in that account too. So we're going to take off 15,400. So let's hit on the same page. We need this stupid handout. All right. So we're taking off what we have on the books for the accounts receivable. We had the 15,000 originally. We had another 400 to it, and we still don't balance. What do we need?
Translation gain, 600.
Yeah. So translation gain of 600. And if you think about it, between the 31st and the 15th in 2004, we made that $600 gain. So even though the overall gain on this thing was 1,000, 400 of it was in 2023, which we'll recognize, and then the other 600 was in 2024. And that just lines up with when those actually occurred. Those changes in the translation. Oh, this one's a little bit interesting. Okay, this one, same as before, 100,000. And it's at 17 each. 17,000. Oops. Okay, so that is year end. Yuan. I don't know if that's how you pronounce that or not. So what's the journal entry going to be?
So accounts receivable. So that's like 2,000.
Yeah, so this is accounts receivable. This is actually, oops.
The translation loss, right?
Yeah. So this is actually an asset going down. This account is worth $2,000 less now. And yeah, that'd be translation loss. Okay, so coming down to February 2nd, and now it's up to 18. We'll do the easy part. And what's the rest of it going to look like? Oops.
So next entry will be translation gain.
Yep. And here's the tricky part: for how much?
Should be 1,000, no?
Actually, it's going to be more. We had accounts receivable on the books for 17,000. We took off 2,000. So the accounts receivable is now
So 3,000 then for the gain.
Yep. Accounts receivable is down to 15,000. So yeah, 3,000 would be the gain. And if you think about it, if between the year end and when they paid us, we should recognize the gain of that's when it happened. It happened in 2024. So we were right to recognize the loss because the loss happened in 2023, but then this gain on the currency happened in 2024. Okay. These are kind of the same thing, just the other way around. Okay. Yeah, the purchases are similar. Oops, wait. Okay, Okay, the Jens Company made a purchase of equipment in Indian seller for 500,000 Indian rupees. The purchase exchange rate was 0.022 per one Indian. Okay, so let's see here. So this would be 500,000 times equals that 11,000. Okay, so this is an $11,000 piece of equipment. Oops. All right, so we're going to have our equipment. Let's try that again. It's an asset going up by 11,000. And we have accounts payable. We have a liability going up by the same 11,000. Oops. So we got more assets, but we also have more liabilities now. Okay, so, oops. We come down here to pay this off. We get our, so we go buy our rupees to pay them with. And they're 0.025. So let's see here. Should be able to do that in my head. 12,500. All right, so this is us paying out this money. Oops. Hey, what I do? So cash, asset going down by 12,500. We have accounts payable for 11,000. So liability going down. Now pay it off. What else do we need?
Translation. loss or what?
Yep, translation loss 1,500. Yeah, we had the liability on our books for 11,000, but when we ended up paying it, we had to pay 12,500. And again, it wasn't like we got a more expensive piece of equipment. It's just a loss from the translation. Oh, okay. Similar one. This one has a year end in there. All right, 1 million rupees. Just make them all a million or 100,000, nice round numbers. Okay, 24,000. See, that's why you should have all these. Okay, so more equipment. Equipment is asset going up. 24,000. And we owe them. The liabilities are going up. We owe them $24,000. Actually, we owe them a million rupees. But we translate into US dollars for our books because we keep our books in US dollars. Okay, the new exchange rate for rupees is 21. And this is at year end. So, what's the journal entry going to be?
Accounts payable and translation loss.
Close. Accounts payable is going to go down by what, 3,000?
Yeah, 3,000.
This is actually a translation gain. We owe less now. We owe 3,000 less. Okay. And we come down here. Now it's dropped down to 20,000. I'm in the wrong spot. Oopsie daisy. There we go. That's what I meant to do. Okay, so we're actually going to only have to pay out 20,000 to pay this off. All right, so let's see, what would the journal entry be?
Cash.
Yep. So cash. You don't need to put this in there. I'm just putting it in so we know this is debit or credit. Cash is an asset that's going down. So we take our $20,000, we go buy a million rupees so we can pay this off. So 20,000. What do we have in the accounts payable?
Uh, is it like 17,000, right? Or no?
No, 21,000.
21.
Yeah, 24 minus the 3. So we took 3,000 out of our accounts payable. So we no longer owe 24. We owe 21. We're paying off the liability, 21,000. So we paid off a $21,000 liability, but we paid it off with 20,000. Is that good or bad?
Good. So 3,000 or 1,000 gain, right?
Exactly. Yeah, so we had a translation gain of 3,000 that occurred in 2023. We recognize that. And then another 1,000 that a gain that we had in 2024. And again, so you might say, well, why don't we just, why do we have a gain or loss? Why don't we just pick the machine? Well, the machine is assuming this was a arm's length transaction, it's a $24,000 machine. It just happened that the currency underneath it changed. Okay, we're not going to go too deep in the rest of this. Derivatives get their name because their value is derived from something else. So there's something underlying a derivative that gives it value. The coupon example. Okay, so we got a coupon to buy a phone for $100. The value of the coupon depends on the phone. So if the new phone is really costing $137, then the value of the coupon is $37. Right? It's going to save us $37 if we have this coupon. So the value is derived from it. If the phone regularly costs $88 and the value of the coupon is worthless, you're not going to use the coupon of $100 to buy a phone for $100 if you can buy it for $88. So derivatives mean that the value is derived from something else. It could be stocks, bonds, whatever. In this case, we're going to look at, it's going to be based on the exchange rates. Future contracts and option contracts. You guys probably covered this in other classes, I assume. Future contracts, they must buy or sell something. So you must buy 100,000 euros at $1.05 each. Options contracts are that you may buy. You may use the option or not. So option contracts, yeah, how come I don't have that capitalized? Yeah, I didn't capitalize it again. Option contracts are gonna get mad at me. I got a hanging comma out there for some reason. And so this is the right to buy without the obligation. So this one, futures, you must follow through with the contract. Options contracts, you may. And so the value of these contracts is basically based on what the exchange rates are. So the changing of the exchange rates will change the value of these contracts. That's why these are called derivatives, futures and options. I used to work at the Chicago Options Exchange at the SIBO. I used to do, I don't know if you guys are into finance, I used to do gamma adjustments on the accounts. They used to do trades in stock, and the stock trades were as a percentage of the stock itself. So they may have an option contract that trades like 60% stock. So if they have a contract on 1,000 shares of stock and it trades at 60%, you have basically a 600 shares of stock is what you base it off of. Okay, derivatives can increase or decrease risk. Now, generally speaking, when we're doing these transactions, you may want to hedge these transactions. And usually you can pay a little bit of money, and especially if these are larger dollar amounts, if these are in thousands of dollars, but if they were in millions of dollars, you may not want to have that kind of uncertainty out there. So hedging a contract, they must have 3 conditions to hedge a contract. So if you're going to hedge a contract, these are the 3 conditions. You have to have a cash flow exposure. In other words, there has to be a reason why you're doing this. The hedge itself must be effective in offsetting these. And it must be documented as a hedge. And you might look at these 3 and say, well, who cares? I mean, why do we care whether, if all these are there or not? Well, the reason you do that is because if those aren't met, then this is not considered a hedge. It's not that you're trying to facilitate a transaction, that you would actually be making an investment. And people do. There's some people that will buy and sell options and stuff, even though they have no transaction. And you can do this. I mean, it's not nothing wrong with that. Sometimes investors will. They'll either buy or sell these option contracts as an investment. They're trying to make money off of them, not trying to hedge, a regular transaction. These are there to hedge transactions, but you don't necessarily have to have that. They're not. If you buy an options contract, they're not going to ask you, do you have a transaction underlying that? So anyway, these are. It is possible that companies, and especially larger companies, that they do hedging on these contracts, and usually, especially for larger dollar amounts, a lot of times it's fairly minimal. The cost to lock in a price, but anyway, these future and options contracts. By the way, oftentimes these contracts, even the future ones, are not actually fulfilled, because what happens is that near the end, if they're pluses or minuses, someone will either buy them or sell them to get rid of the contracts. So oftentimes these are actually not fulfilled. But for example, let's say that you bought an option contract, you paid whatever for it, and then you figure out that at the end, that maybe it's that contract saved you $1,200. You could go through the putting it to them, the exchange rate for these, whatever currencies underneath there. But what often happens is someone will simply buy the contract from you, give you the $1,200, and then you take whatever the gain or loss is on it. And again, it's going to wash out to be exactly the same. The value of the contract at the end, when you find out what the excise price is on the thing, that in the rate at the end of the contract, you know exactly what the value is of that contract, and usually someone else on the other side will buy it, and then give you the money, and it'll offset whatever loss you have. So anyway, any questions on that? Okay, that's all we're going to do with those, and basically you have to know how to do the accounting for the changes in the underlying foreign currency. Again, if they do the transaction in U.S. dollars, which is not unheard of, a lot of times they will do transactions in U.S. dollars, but if they do it in U.S. dollars, then there is no translation gain or loss. If they do it in foreign currency, if you're receiving foreign currency or you're paying foreign currency, that's when you'll have these translation gains and losses. And if they're for valid transactions, they are simply going to be go on the income statement. Any question on that? Okay, I think I put that in. I think you guys can turn that in, and I will send out the and post the chapter 4 and 5 exam. Those will be posted by today, and I'll also send out an email with it. Okay. Any questions?
I'm good.
Okay, good. Oh, I went a minute over. Darn it. I'll make it up for you guys next week. All right, see you guys.
Take care. Bye.